Well, hello, and welcome to Chapter 17, where we'll talk about some leases and some of the differences between operating and capital. So, one of the more exciting parts, really. Anyhow, when it comes to leasing, sometimes when you lease an asset, it's a more cost-effective method of paying for any property and equipment. So rather than coming up with a lump sum amount of cash for, say, $100,000 or $1 million worth of capital, you can pay for it over a period of time. Sometimes it's the full useful life, sometimes it's not, and it depends. And so depending on some of the variables and some of the considerations, it can be considered an operating or a capital lease. That's what this chapter is all about. So the second bullet on this slide talks about how leases can be structured, and it can be very controversial, meaning that depending on decisions made in terms of a lease, etc., they will or will not be on or off balance sheet. So you have to be very careful that you're not trying to avoid disclosing an asset or liability by having this lease arrangement, but that you're acting in the best interest of the parties involved. Any lease is an agreement with specific terms between the owner of the property and the debtor, okay? And sometimes it's as far as you have the asset, but you might have a lessor that provides funding only. So maybe you buy an asset to get it financed through a third party. So we're going to walk through some of these different components today. Okay, so when it comes to leasing, some of the advantages, you typically have a fixed rate. So you can get up to 100% financing. Typically, it's at a fixed rate for the period of the lease term. So it could be 5, 6, 7%, 10%, whatever that rate is, but you don't have to worry about fluctuations. So that helps give you a more predictable cash flow. Sometimes when you lease, you typically turn over, or you have the option to turn over that asset on a regular interval, 3, 4, 5 years. So it helps protect and reduce the impact of obsolescence of that equipment. It gives you flexibility with, cash payments, the newness or age of the asset that you're purchasing and financing. Typically, it's less costly for the lessee. So for you as the organization leasing the asset, sometimes it's less costly. There can be tax incentives as far as being able to write off the lease components in different ways. And sometimes it could be considered off-balance sheet financing. So again, it depends on the payment structure and the terms, whether it's considered an operating or capital lease, whether it's disclosed or not. So the lessee is considered the rentee or the financer. The lessor is the owner, which I just see a spelling mistake there. All right, so under leases, there are some different types. First one we'll talk about is direct financing type lease. So any sales on a direct financing type lease are recorded at the present value of the minimum lease payments. So the seller or buyer, it doesn't matter which side, you look at the lease payments over the life of that asset and present value them, and that becomes your direct financing sale or purchase price. Any lessor are typically in the business, the finance business, to earn interest income. So sometimes, we could work with a TD or a Scotia or another financing organization. So they would typically be involved in a lease arrangement in order to generate income. That's all they're in the business for. In a sales type lease, lease payments include the recovery of a manufacturer or dealer profit. So there's a sale and a cost of goods sold associated. So sales are recorded at the present value of the minimum lease payments again. The cost of goods sold are recorded at the cost of the asset being sold. This is a situation where we actually provided an asset or purchased an asset with a lease stream associated. So there are two pieces: an asset, or the cost of goods sold, and a lease associated. Under IFRS, then we have to ask ourselves, is this lease a capital lease or an operating lease? And there's a bunch of criteria summarized up into these 4 categories. And if you answer yes to any of these, it becomes a capital lease, okay, which capital lease we'll explain more throughout this chapter, but that means you have an asset and a liability in this transaction. So So the first thing is there a transfer of ownership? So what this is if you have a lease where, say, there's an option at the end of the lease to buy it at a bargain price, sometimes a lease will say, hey, you'll lease it for X dollars for 6 years, and at the end you can buy it for $1. Well, basically, you've owned that asset. The second one is the economic life test. So is the lease term for the majority of the economic life of the asset? Third one is there recovery of investment by the lessor test? The lease term allows the lessor to recover substantially all of the investments and earn a return. So are you paying for the majority of the cost of that asset? So not just the economic life, but the value. And the last one is it a specialized nature of a leased asset? So it can only be used by the lessee. So say it's a piece of equipment that the organization we buy it from or lease it from, they can't use it and they build it for us. Well, realistically, it has no other use, so it can be considered a capital lease. Some of the exceptions when it comes to capital lease or not, if it's a low dollar value item, we wouldn't bother capitalizing it, or if it's short term. So say you leased an item for a year, you would just expense it accordingly. All right, so under ASPE, is the lease a capital lease or operating lease? It can meet any one of the following. Is it a transfer ownership test? Is the economic life test greater than 75% of the leased asset's economic life? And is the recovery in the investment greater than or equal to 90% of the fair value of the leased asset? So very similar tests under ASPE. And then once the test is completed, whether it's a capital or operating lease, you also need to say, are the lease payments will be collected and that there's no uncertainties about cost. So, it's a given that lease payments will be made and you know exactly what those costs are for that lease term. Some of the definitions in this chapter, the first one being executory costs. So that's any costs that are required to be paid to maintain this asset. So it's not just the cost of the lease. Sometimes there's insurance that's required within a lease. Sometimes there's maintenance costs that you pay over the lifetime. And those are all considered part of executory costs. Sometimes they're included in lease payments. Sometimes they're in addition to lease payments. You need to watch out for those terms in a lease. Depreciation, remember depreciation, whoever uses the asset can depreciate the asset over the life of the lease, okay? So in this case, if it is a capital lease item, you would have the asset on your books, and even if it has, say, a 6-year useful life, but if your lease term is, say, 5 years, you would actually depreciate that asset over the 5-year period instead. So for a straight line, it would be fully depreciated down to the residual value. If it's in declining balance, it'd be 20, 30% per year for those 5 years. Under amounts guaranteed, it's any amounts guaranteed by the lessee, like residual value. So sometimes there'll be a guarantee within a lease contract that says we guarantee it'll be worth X dollars at the end of the lease. And it'll determine whether or not it's included in the present value calculation. A bargain purchase option is a clause that allows the lessee to buy the asset at an amount much lower than the asset's fair value. So typically, if you look at an asset, 5 years, say it's 100,000, maybe it should be worth 20,000 on the market, but your lease says at the end of the 5 years, you have the right to buy it for $1,000. Well, that would be considered a bargain purchase option because it's much lower than the fair value at that point in time. Under the interest rate, under IFRS, the interest rate is implicit in the lease. So it's considered to be the incremental borrowing rate of the lessee. Under ASPE, it says it's the lower of either the lessor's implicit rate or the lessee's incremental borrowing rate. So if one has a 5%, one has a 4%, it'd be the lower of those two. When it comes to some of the journal entries, and again, we'll have some examples in this chapter, there'll be journal entries on the lessee side, the person borrowing that asset and paying over time. At the inception of the lease, the present value of the minimum lease payments becomes a debit to the equipment under lease and a credit to the obligations under lease. So you have both an asset and a liability. Then any lease payments, you have your initial lease payments, you might have executory expenses that you need to expense. and then you would reduce your obligation under lease over time, and then you'll credit cash. You would then also accrue and record any interest expense using the effective interest rate method, and then you would record any depreciation over time. Under ASPE, a sales type lease, at the inception of the lease, the present value of the minimum lease payment would be a debit to lease receivable. So this is on the lessor side, a debit to the cost of goods sold, a credit to the sales revenue, a credit to inventory for the cost of goods sold, and then a credit to unearned interest income, because that becomes earned over the period of the lease. Then you'd have the initial lease payment going to cash and reducing the lease receivable, and then over time you'd report any interest earned. Under ASPE for a direct financing lease, you'll have the present value minimum lease payments. You'll have a debit to equipment under lease, just like earlier, and a credit to obligations under lease. And then over time, you would reduce the obligations under lease as the lease payments are received or made. On the lessor side, for the person leasing out the item, you'll have a lease receivable debit for the present value. You'll have a credit to the asset because we've sold the asset and we bought it for that lease purpose, and then a credit to unearned interest revenue. And then we would reduce the lease receivable as payments are made. And then obviously any interest. And continues under IFRS for a direct financing lease. The lessee side, the person getting the asset, paying over time. Present value of the minimum lease payments would be a debit to right of use asset and a credit to lease liability. Lease payments would reduce the liability. We would accrue any interest and record any depreciation. So hopefully you're starting to see some similarities. Under IFRS for a direct financing type, on the lessor side, the person that or organization that bought the equipment to lease out to a company, they would debit the lease receivable, credit the equipment acquired for lease, credit unearned interest income. They would earn that interest over time under point 3. And then as the lease payments are received, the debit to cash and reduce the lease receivable accordingly. Accounting for a sales type lease under IFRS, under the leasee side, the present value of minimum lease payments would be a debit to right of use asset, credit to lease liability, which would be reduced as we made payments. We would record any interest expense, again, over time, and any depreciation. All right, moving on to presentation and disclosure in the financial statements. You will have to disclose the current versus non-current portion of those liabilities. So any principal portion, principal only, from the amortization table that will pay with 12 months is considered current, just like any other definition. And long-term is the rest of the principal portion outstanding. So consistent with our previous definitions. Under our capital finance lease disclosure, we'll have to follow any disclosure requirements based on the asset that's capitalized and any long-term liabilities. So, you know, if it's a capital asset that we did capitalize, it'll be on our capital asset note to our financial statements, and liabilities will be disclosed. There will be a reconciliation of those future minimum lease payments. Okay, and if you recall from previous chapters as well, in your notes of financial statements, those are considered commitments, and you would break them down with how much is due in the next 12 months, how much is due in year 2, 3, 4, and 5 separately, and then a total amount for 5 years and beyond. Okay, standard disclosure for commitments. We would disclose any material lease arrangements. So are there contingency payments? Are there sublease payments? Are there any restrictions based on the lease agreements? These would all be considered note disclosures as in notes the audited financial statements under IFRS. Under the operating lease situation, the only thing we'd have to disclose is the commitment amount, how much is due in the next year, to year 2, 3, 4, 5, and then how much is due after 5 years. We would have a note to the financial statements that would disclose any material lease arrangements as well, any sublease payments or restrictions imposed. So that's it kind of for the theory. We're going to move on to some examples.